Imagine watching a company grow from an online bookstore to a trillion-dollar empire, and doing absolutely nothing about it. Now imagine you're Warren Buffett, arguably the greatest investor in human history, and you're the one who missed it. Not because you didn't know about Amazon. Not because you didn't admire Jeff Bezos. But because of one stubborn mental block that cost Berkshire Hathaway's shareholders hundreds of billions of dollars in potential gains. Today, we're breaking down the full story. Why Buffett missed Amazon, what he said about it, what he learned from it, and what you can take away from one of the most expensive mistakes ever made by the world's most famous investor. Stay with me, because this one will change how you think about investing forever. Let's go back to the late 1990s. Amazon went public in 1997 at $18 per share. Within 2 years, even after the dot-com bubble fears, it was clear that Jeff Bezos wasn't just building a bookstore, he was building the infrastructure of modern commerce. Warren Buffett knew this. He watched it. He even said he watched it. At the 2017 Berkshire Hathaway annual shareholder meeting, Buffett openly admitted, "I had every opportunity to invest in Amazon early on. I thought Jeff Bezos was extraordinary. I just didn't think he could pull it off at the scale he did." That's the key phrase. He didn't think Bezos could pull it off. Now, let's be fair, in the late 90s and early 2000s, Amazon was burning cash. It wasn't profitable. It looked, on the surface, like exactly the kind of speculative tech bet that Buffett had always avoided. And for a long time, that caution seemed smart. The dot-com crash wiped out thousands of companies just like Amazon, companies burning cash, making big promises, and delivering nothing. Except Amazon wasn't like those companies. And deep down, Buffett knew it. Over the years, Buffett has been remarkably honest, even brutally self-critical, about missing Amazon. Let's go through what he actually said. At the 2018 Berkshire annual meeting, Buffett said, "I've been a fan of Amazon from early on. I just didn't think it would get this big this fast. It's one of the most remarkable business achievements in history." He also admitted something even more telling. "I was too focused on what I could understand. Amazon kept expanding into areas I didn't model correctly: AWS, cloud computing, Prime, logistics. Each one would have been a massive business on its own." That's the honest truth. Buffett's framework, his famous circle of competence, kept him out of tech for decades. And while that discipline saved him from many disasters, it also cost him Amazon. He even said at one point, "I made the mistake of thinking the business was harder to predict than it was." Think about that. The world's greatest analyst of business economics, a man who read 500 pages a day, underestimated Jeff Bezos. And here's where it gets even more fascinating. Buffett didn't just miss Amazon stock. He missed seeing Amazon destroy industries he already owned: retail, logistics, even grocery with Whole Foods. He was watching Amazon eat his portfolio, and still not buying in. Let's talk about the scale of this miss, because the numbers are staggering. If Berkshire Hathaway had invested just $1 billion in Amazon in 2002, when the stock was trading around $15 after the crash, that position would be worth over $200 billion today. Even a 2012 investment at around $200 per share would have returned more than 15x by the time Berkshire finally bought shares in 2019. When Berkshire did finally buy Amazon stock, in Q1 of 2019, they paid an average price of around $1,700 per share. Buffett openly said it wasn't even his decision. It was one of his portfolio managers, Ted Weschler or Todd Combs, he wasn't sure which one, who pulled the trigger. Buffett joked about it. "One of the fellows in the office that manages money bought some Amazon, it was not me." He laughed it off. But you could hear the regret underneath. The lesson? Even the best investors in the world have blind spots. And Buffett's blind spot had a name: Jeff Bezos. Now here's where this story becomes genuinely valuable, not just as financial gossip, but as a masterclass in investing psychology. Buffett didn't just throw his hands up. He reflected. He evolved. And he gave us some incredible insight into what he took away from the Amazon miss. Lesson number 1: Extraordinary CEOs deserve extraordinary exceptions. Buffett has always said he prefers buying wonderful businesses at fair prices. But he admitted that with Amazon, he failed to fully price in the Jeff Bezos variable. He called Bezos the most remarkable businessman I've seen in my lifetime, and said he should have weighted that more heavily in his analysis. After Amazon, Buffett began paying closer attention to founder-led companies with visionary leadership, which partly explains his growing respect for Apple under Tim Cook, a stock Berkshire eventually made its largest single holding. Lesson number 2: Too hard isn't always an excuse. Buffett has a pile in his office labeled "Too hard." It's where he puts investments he can't figure out. Amazon went in that pile too many times for too long. After the miss, Buffett acknowledged that some businesses that look too hard actually have very durable competitive advantages. They just require a different mental model to understand. Lesson number 3: Disruption isn't just a risk, it's an opportunity. Buffett always feared tech disruption. He avoided tech stocks partly because he worried about companies getting disrupted into obsolescence. But Amazon was the disruptor. He was watching the wrong side of the equation. He later said, "I should have recognized that Amazon wasn't just growing, it was making everything else obsolete." That's where the real value was. It's worth noting, Amazon wasn't Buffett's only tech miss. He also passed on Google, even after Geico, one of his own portfolio companies, was one of Google's biggest early advertisers. He watched the money flowing to Google and still didn't buy the stock. He admitted, "I blew it." He passed on Microsoft, despite being Bill Gates's close personal friend for decades. The pattern is clear. Buffett's framework was built for the industrial age, for railroads, insurance companies, consumer brands with moats you could touch. Tech companies had moats too, but they were invisible. Network effects, switching costs, data advantages. Buffett struggled to see them clearly. The exception, and this is important, was Apple. When Berkshire started buying Apple in 2016, something had changed. Buffett didn't buy Apple as a tech company. He bought it as a consumer brand with extraordinary customer loyalty. He reframed it. He called it the best business I know in the world. That's the evolution. Amazon taught Buffett to look harder at things that seemed too complex. Apple proved he could learn. So what does all of this mean for you as an investor? First, even the best get it wrong. Buffett missed Amazon. Munger missed Amazon. If they can miss trillion-dollar opportunities, you will miss some too. That's not failure, that's investing. The goal isn't perfection. It's a process. Second, know your blind spots. Buffett's blind spot was tech. Yours might be something else. Maybe you avoid international stocks, or small caps, or certain industries. Identify it. Acknowledge it. And at least consider whether your avoidance is wisdom or fear. Third, price in the person, not just the business. Buffett admits he underweight Bezos. Great founders and CEOs can bend the curve of what's possible. When you find one that matters. Fourth, circle of competence can be expanded. It doesn't have to be a cage. Buffett learned. He adapted. Apple proved that. It's never too late to grow your circle. And finally, compounding favors the patient, but only if you actually buy. Buffett's biggest regret isn't that he didn't time Amazon perfectly. It's that he never bought it at all. Sitting on the sidelines waiting for certainty is its own kind of risk. Warren Buffett once said, "The most important thing to do if you find yourself in a hole is to stop digging." But maybe the deeper lesson from Amazon is this: sometimes the hole isn't the one you're in. Sometimes the hole is the opportunity you didn't dig into. Buffett is still one of the greatest investors who ever lived. His track record is unmatched. But even he will tell you, his biggest mistakes weren't the companies he bought and lost money on. They were the ones he understood, admired, and never bought. Don't let that be your story. If you found value in this video, smash that like button, subscribe for more deep dive investor breakdowns, and drop a comment. What's your Amazon? What's the company you've been watching and haven't pulled the trigger on yet? I'll see you in the next one.